Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday. Welcome to the latest episode of the Prime Property Finance Podcast. In this episode, Mark and I are going to deep dive into semi-commercial property, what investors get wrong, some of the misconceptions, the complexity and the financing pitfalls. And then also we're going to go through why some semi-commercial property can outperform buy-to-let and offer better stability and yields when done properly. So we're going to run through some of the pros and cons, how finance works and deep dive a little bit on that. So without further ado, let's get into it. Welcome back, Mark, to the latest episode of the Prime Property Finance Podcast. And this week we're talking about semi-commercial property finance, which is a pretty interesting topic, one that we are seeing more and more of. But before we get into that, let's talk about the advancement of the facial hair, or lack thereof. Some of us have developed a stronger tash than others. What's your thoughts? Where are you at?
Mine's just blended into my face. Yeah, and I already had a head start as it was. So it just sums up my beard and moustache growing capabilities, not my strength at all.
I noticed this week that a couple of the women in the office had a stronger moustache than you.
Yes, indeed. And that tells you everything you need to know about my moustache. So for those viewers that can't see it, there's nothing to see.
Nah, it's good. It's been good fun, and obviously it's important to raise awareness for men's health and make sure that you do go and get yourself checked out, because these things can be helped and fixed if you deal with them early enough. But if you do leave it too long, then it can catch you and it can have some catastrophic outcomes. So yeah, we laugh and joke about it, but there is a serious element to it as well. So do get yourself checked out. So with that put to one side, let's talk about semi-commercial property finance. So yeah, I guess there's lots going on at the moment. We're coming towards the end of the year now, and the market's been a little bit flat based on what's going on, based on the budget that was yesterday, and we've probably seen a little bit of investors holding off with some purchases and others being a bit more aggressive because in an uncertain market, there's some good deals about. And, what seems to have been becoming more popular is semi-commercial property and things that we're doing a few more cases of that at the moment. And we're getting more questions on it. So we thought now would be a good time to go a little bit deeper on it in here. So do you want to just give us a bit of background about what semi-commercial property actually is compared to maybe other types of investing?
Yeah, sure. So semi-commercial is known by other names. Mixed use is another term it may go by. Shops with uppers is something else as well that you'll hear. I mean, they're all words for the same thing really. So it's a hybrid of, or a mix of, residential and commercial. Okay, so there are varying degrees in what that split is. It doesn't necessarily need to be 50-50, 80-20, whatever. It can be any form of split is deemed to be mixed use. How we treat it will differ depending on the actual breakdown of the property itself. As I say, more traditionally, what we tend to see now is investors looking for different or better yields, because commercial can provide better yields. Having the residential element arguably de-risks it somewhat, because there is a well-trodden path around the residential that will often cover the cost in many respects to the mortgages involved with it, and that means the commercial space then can be let out and so on. So we are seeing more and more inquiries with it. It is something that you need to understand, and we obviously try and unpick this as much as we can as part of this episode, because I do think that some newer investors, for sure, think this is sort of a silver bullet to fixing some of their investment problems, especially if you're looking to do conversions and those sorts of things. But there's a fair bit to consider. around this, not just in terms of finance, but some of the moving parts that exist within this mixed-use semi-commercial space.
Yeah, absolutely. So you've touched upon why you think sort of semi-commercial is becoming a little bit more popular. And I guess, higher yields, yes, because what traditionally the traditional buy-to-let market has been a single residential dwelling that people rent out to a family or a single person or whatever. And those get this slow and steady, but they're not sexy by any stretch in terms of what they are and their performance. They're long and boring assets, which are great assets to own, but they're not. If you've got a desire to grow your portfolio quickly or to leave your job, so you need more cash flow, then people have been looking traditionally at other areas of investing, such as HMOs, which is a house of multiple occupation. So you've got a number of rental incomes from the same property, and then multi-wheel unit blocks, which again is a block of flats, which is multiple different streams within the same property. And ultimately, semi-commercial is just the next step on that ladder, isn't it? Where you may have a shop on the ground floor, a retail shop, it could be a charity shop or whatever, and then a block, it could be 1 flat, 2 flat, 5 flats, 6 flats or more in the upper floors above the ground floor, generally retail space. So that's why it's becoming, it's just a multiple levels of income off the same property, which produces then a higher yield. And so why is that becoming more popular? Well, obviously in England, you've got PD rights, which makes it relatively easy to convert an office or some spaces into flats. So you might keep an office on the ground floor or some retail space on the ground floor and then convert the uppers into flats without the need of full planning permission. So in England, that's a popular avenue from a development perspective. But also, like you said, it's just an alternative to the residential market where obviously increasing regulations, there's an opportunity to go, moving away from that regulation and having direct tenants. There's a little bit of a mixed exposure then to the commercial market where there's different rents. The laws are different around how you can evict tenants if they don't pay and things. And generally it's longer term leases. And the tenant in the commercial space usually carries out all the repairs as well. So there's a good blend and a mix of risk ultimately, which is why it seems to be becoming a lot more popular.
Yeah, definitely.
So obviously, we've talked about a little bit why they're becoming popular and what are the main kind of, before we touch on the lending elements, and we've touched a little bit on there, what are the kind of main property types that you're seeing coming through on a semi-commercial basis?
Yeah, so what we're currently seeing is a lot of high street. So, if you look at the set of circumstances that lends itself to a property even being available on the marketplace, available for you to look at and consider, we all know that the high street's taken a bit of a kick in over the last decade or so, if not more, with the growing popularity of online shopping and all of that sort of stuff, and arguable mismanagement by councils, whatever. But there is the high street is struggling. That then means there's a lot of vacant commercial units on the high street. The uppers may well be occupied, which then makes it almost a palatable risk to take because it's income generating despite the ground floor perhaps not being occupied. And therefore, when you do the numbers and go, well, if I can get a tenant in there, then these numbers jump up to X. But the risk is quite low because you've got that residential element sort of covering at least the core borrowing that's required. So those are really popular. I'd say that equates to probably 90% of what we see. We will see some more colourful or more unique types of properties, but they are more nuanced. And those are probably more experienced investors that see a bigger potential opportunity from that. So definitely the high street shops up is a real popular one.
And I guess not everything remains equal. Either is it because you can have two properties next door to each other, one being a charity shop with 3 flats above, and one being a fast food takeaway with 3 flats above, and they'll be viewed very differently in lenders' eyes, won't they, in terms of their value and their forward sellability if need be from a repossession point of view. So whilst this is a generic space, the semi-commercial space, the proposition, for want of a better word, isn't exactly necessarily the same, is it?
No, absolutely. And so I'm going to come on to the lenders in due course, and what they're looking at. But you really do need to make sure that the lender and the property match. And we'll come into why that's important and how that can fundamentally change a deal. But having a good understanding as to what you're trying to achieve. I know we always revert back to, start with the end in mind and all of that. But, as you increase the risk profile, because that's ultimately what you're doing, that consideration needs to be even greater. What is the end outcome? What are you trying to achieve, etc.? Because we want to make sure that you're in with the right lender who can support you through that journey. Because it probably won't be straightforward. Is our usual experience. There's a few challenges along the way, especially on the commercial element.
Yeah, absolutely. And I think one of the other really popular parts of semi-commercial property compared to residential is the stamp duty or land transaction tax, depending on where you are in the country. But they're very different. So the residential rates don't apply. It's based on commercial rates, and they are very different to what you pay on residential. So the acquisition costs can be a lot lower. And that's always a positive from an investor's point of view. So that's another reason that people have been kind of drawn to it. So should we talk a little bit now around how the lending works on semi-commercial? What are the key things that lenders would look at, and what kind of lenders are in this market?
Okay, all right, where do we start? Okay, at the beginning, as they always say. So, right, there is strong appetite in the space for mortgages on these types of properties, okay? Now, how they view it differs a lot between lenders. Now, you've got your lender that is a true commercial lender. When I say commercial, I do commercial mortgages and that sort of thing, okay? And then you've got your buy-to-let lenders who only do residential. And then you've got your specialist mortgage providers who kind of sit in the middle of those two lenders and will do semi-commercial, but probably with a buy-to-let hat on, not necessarily a commercial hat on. Okay, so those are the three tranches, for the purposes of this conversation, those are the three tranches of lenders that we're looking at. We're ignoring the residential, the buy-to-let lenders, because they just won't get in this space at all, and then focusing on the specialist mortgage. Now, if you are dealing with somebody who is a commercial mortgage provider, let's take Shawbrook, for example. Okay, now they can do mixed use, they can do residential, you can do commercial. When you present that to them, it doesn't matter if it's semi-commercial or commercial, because they have a product and an offering that could tick either box. So that doesn't matter so much. And their flexibility around how the property is valued will lean more towards the commercial side of things as well. The specialist mortgage lenders have some criteria around whether they can or can't lend on it. And that criteria is pretty prescribed as to what you need to satisfy in terms of the property. So what we're looking at here is there is a 60-40 rule in semi-commercial for the specialist mortgage lenders, and that is 60% residential and 40% commercial. Now, there is nuance within that, within the lenders again, further to say some lenders will only consider the square footage of the property, split 60-40, what's the footprint of the resi of the commercial. Other lenders will say we want to know the square, the footprint split. We also want to know the revenue split, and we want to know the value split. All three of those metrics need to fall within the 60-40 for us to lend against it. And the reason for this is that to do with their lending book and their permissions and what have you, and how they can lend, as long as it falls into the 60-40 rule, it's still deemed to be residential. Therefore, they sort of skirting and playing with semi-commercial as opposed to being full-blown in semi-commercial. So it does come with some benefits using those types of lenders, because they can be a bit cheaper than your more true commercial lenders. However, if the valuation doesn't support that 60-40 and it falls outside one of those metrics, you may find that you just wasted some time and energy and money going to a lender that you ultimately can't proceed with. Now, if you start with a commercial lender on a semi-commercial basis and that doesn't fit within the 60-40 rule, they'll simply just offer you a product that's a commercial product instead. So you haven't wasted your time and energy and so forth. So there is a lot of nuance within this space, and we haven't even covered about what type of commercial there is. This is literally just to do with, is it semi-commercial or is it not? And there are a few rules to adhere to within that.
Yeah, there's one you missed out there as well, so you've got the footprint, you've got the the value and the income, and some will actually just go off how many units there are as well, aren't they? So if it's a commercial and one flat, that's just in their eyes, that's a 50-50 split, in which case it won't meet that. Whereas if it's the commercial and two flats, well, there's 2/3 is residential and 1/3 that meets the 60-40 split, then that'll work. So, and it can be that black or white from a criteria perspective, can't it? So it's, really important to know what your starting point is before you get in, and then what your risks are from an application point of view. Well, if there is a little bit of risk, are we going to go to a lender that's going to be, well, if you fall outside of that, then it's a no and we can't help you any further. Well, that's a bit of a painful process. Whereas if you go to a lender knowing that, okay, well, if there's a no there, they can flip you onto the commercial element, then that's obviously a choice that well made up front in the process. And that's ultimately where a good broker will support that.
Yeah, and we'll come on to the valuations there as well, but it's the other thing to consider there is, if it is done on value and income and those sorts of things, is the valuation methodology that's being used. Specialist mortgage lenders won't do anything more dynamic than a vacant possession valuation, which, if you've got a retail unit with an 8-bed HMO above, you're probably interested in the commercial valuation on a HMO. Depending on the occupancy on the ground floor, you might be interested in the commercial valuation of the ground floor. So there's a few moving parts with that as well as to how that potentially knits together. And that's where I come back to, what's the end goal here? Because you may not need to be as ambitious as commercial valuations across it all. And you may only need to, a vacant possession might work all day long. Perfect. Go after the lower rate and do all of that sort of stuff. Actually, if the numbers don't support it at that level, then we might have to go down that road, which rules out a lot of the other lenders then on the way that they would value that type of property.
Yeah, absolutely. So you've touched on valuations. So I guess probably a subject that we've spoken a lot about on this podcast since we've launched it, and one no doubt that will keep coming up. But for the purpose of people listening to this for the first time, possibly, do you want to just share a little bit more around the various different, methodologies from a valuation perspective on a semi-commercial?
Yeah. So
just high level.
Yeah, sure. So with regards to that, then there's a few different ways you can value the property. This is true for whether it's commercial, semi-commercial, or residential, to be fair. The most common one is a comparables-based valuation. So they look at other properties within a set proximity and sold within a period of time. And they'll compare that sale price to your current property and say, in an open market, this is what it will sell for. So you've got that. But with semi-commercial, you've got the added dimension of you've got multiple uses of the property. So you can do a few things where vacant possession is simply, if this property was empty, what would it be worth? Ignore the income it's generating. If this property had no income at all and a bricks and mortar, what would somebody ultimately pay for it? It's a very different question when you say, look, it's generating £100,000 a year and that income is locked in for the next 10 years. Clearly, you can sell that for a lot more to an investor because they'd buy in future income and certainty over that income because of the agreements and so on and so forth. So the valuation methodology also differs a lot on commercial. So you may be familiar with HMOs and how a commercial yield works on a HMO. That's quite prescribed in so much that there's a yield and you multiply that up. Commercial can be different depending on the tenant that you've got in there. The agreements are very different to that of ASTs or occupational contracts. They're longer in term in nature, and they are probably more robust, as in your obligation under the lease from the tenant, which arguably makes them a little more reliable. There's a whole debate on whether that's true or not, but it arguably makes it more reliable in terms of that. You can ultimately the lease on a commercial property, if the tenant doesn't pay, you can sue them. You can't do that on occupational contracts and ASTs. There's a whole process which I'm sure everybody knows about.
Yeah, and also the other element is from we'll touch on some of the other elements of the benefits of it and the nuances. So, and I think that just to touch on the valuation, for instance, so going back to our example of a shop with 2 or 3 flats in the uppers, where we might have Tesco in the ground floor on a Tesco local or Tesco Express, whatever they're called, and them in the ground floor and a couple of flats in the uppers, and then the property next door with a different client is, I don't know, Bob's Bits and Bobs, who's just started up. He's just started up. He's always wanted a bit of a handyman, and he's collects things, and he's just started his own shop for the first time, and he's just doing a bit of a car boot sale type shop, and he's selling odds and ends. And those properties are going to get valued. He's got a 3-year lease. He's a first-time shop owner. It's a new business. And then Tesco has got a 20-year lease with no break clause. Those are very different propositions from a lender's perspective, because if they have to repossess the property, they want to know how easy it would be to sell that property on the open market, and what value would they get back from selling those. And clearly you can see the difference, even if they were paying the same rent, the difference in the value of those properties based on the strength of the tenant back in that lease. So yeah, that has a huge impact, doesn't it, on valuation?
Yeah, and that will also drive then where you went as to which lender you'd be speaking with. So if you've got so we call them covenants as opposed to tenants in commercial speak. So it's the strength of the covenant that's in there. You probably wouldn't want to take that to a specialist mortgage lender who only does vacant possession value, because the value of the lease is not taken into consideration. Again, it depends on your indebtedness and what the ultimate goal is here. But a commercial property with that strength of covenant, you're going to want to take it to somebody who recognizes that value when you're looking to do it. Even if you aren't chasing the higher figures, you'll attract a lower loan to value, which hopefully then translates into a lower interest rate, because the risk profile is obviously a lot less in that basis as well. So yeah, there's a lot of nuance around that. So, I've had an example where I was dealing with a property. It was a Domino's on the ground floor. Again, very strong covenant, 15-year lease. I don't think they had any break clauses from memory. And then above it was like an 8-bed HMO. So we were able to value separately and independently the HMO based on its commercial income. It was fully licensed, etc., and qualified for that consideration. And then we had the commercial element on the ground floor with Domino's. So again, that was done on a commercial valuation. So the outcome on that would have been was significantly different than if we took it to a vacant possession, bricks and mortar value. You're looking at 1.8 million in value rather than probably 900,000. The difference is that much, in those sorts of circumstances.
Okay, so hopefully that gives a bit of clarity on the difference in valuations and how that's come about. Let's talk about some of the sort of nuances or pitfalls around semi-commercial and some of, we touched on a couple of them, but let's dive into that a little bit deeper. Okay,
so in regards to this, the nuances around the commercial is, we've spoken about the covenant being strong. So Domino's is strong, but we also have a look at what the business does as well. So is the business a takeaway? Well, in this particular instance, Domino's is a takeaway. We've got, Pizza Hut delivery and those sorts of things. You've got some other fast food chains that would possibly look to occupy these spaces. Now, traditionally, lenders do not like lending on residential assets that are above or within close proximity to, we say, anything that's noisy, smelly, antisocial type things. So, anything that has takeaways, restaurants, those sorts of things can be more difficult. So you may have the best covenant in the world, and that's great for the commercial element. However, it might make the residential element really undesirable because of the cooking smells and everything racing through the flat. So this is where then it starts to become about trying to make sure that you're knitting all of these component parts together. And this is where, a lot of lenders will only lend to more experienced landlords because of the dynamic that comes with this. It's not just about just filling the ground floor. It's actually about who you're putting in the ground floor. And that leads me on to really properties that we see where you've got 2 flats above that are fully occupied and then the ground floor is unoccupied. that causes more problems from a mortgage side of things than people are aware of, because they're like, oh, it doesn't matter because the rental income is covered by the upstairs. Well, that's fine. But on the basis of certain types of businesses aren't well liked on the ground floor, then that becomes quite challenging to get a mortgage on straight away when you haven't got a tenant lined up to go in on the ground floor and you can't actually explain exactly what use that's going to be.
Yeah, because some of the use classes are very open, aren't they, in terms of what can go in there. So, yeah, I mean, those, which is why one of the key things is people come into us, sometimes and say they'll want to go straight in for semi-commercial, and that always isn't the case, because obviously there's some additional compliance, for instance, that's needed between a semi-commercial and what's needed between a residential. Obviously things like asbestos reports, fire risk assessments. Each element of the semi-commercial would need a fire risk assessment from the freeholder. So if an example, again, if you had a shop and then 3 flats above, and if there were some common areas, then ultimately the freeholder or the building owner should have a fire risk assessment. For the building and for the common areas, you don't need a fire risk assessment for a residential space, but you need it for communal areas. Because if you, for instance, have a takeaway, there's a lot of cooking going on, or actually what people don't realize is with hairdressers have a lot of, the peroxide and various things that are quite flammable. So those can be, so if you could imagine, if you're in a flat above one of these shops and you don't know what the risks are in the shop below, then that can be quite dangerous. So it's important that under the new fire safety regulations that people have those fire risk assessments, and those are shared amongst all the users in the building. And so, and that's even more so with a semi-commercial, yes, but even more so on a mixed use, where you have a number of occupants in a single. So you could have maybe a block of 4 units shared with some flats above. So 4 commercial elements. You could have a beauty salon in one. You could have somebody who distributes on Amazon using a storage facility in the other. But they might be selling fireworks for Guy Fawkes night, and they're storing the fireworks so how would you know what those risks are if you don't know what are they storing in their shops? And if there's a fire, how are you going to get out? And so so it makes total sense, but each occupant is supposed to have their own fire risk assessment, and then there's supposed to be one for the building. People don't understand that. And that usually doesn't come up on semi-commercial until late in the day, usually in the legal process, which is right at the end. And then people haven't picked it up, and then they've got to go and get all of these assessments, and that usually puts big delays on it. So it's understanding the process, and obviously if you're an experienced investor, you have been through this process and understand that there's more to it than just a straightforward residential, and it's treated more like a business as well, which is why they want to see you with some experience.
Yeah. This so I think there's that. Definitely, we've also got, and we've spoken about this before in previous episodes around the commercial element. I mean, a lot of this is going to be a lot of the consideration, the risk profiling is going to be primarily around the commercial piece. The residential is almost a bit of a given. It is what it is, so to speak. But you're also looking at, so you might be buying one that's got a tenant in there. So the next question is, how long is left of the lease? What has their payment history been like in terms of have they kept up? Are there any arrears? How long's left on that lease? Would you be better off renegotiating with the existing tenant to extend that lease and so on and so forth as part of the purchase? The reason being is that, invariably, if a flat becomes empty, there'll probably be a queue of people to come and occupy that, given the shortage of housing that's in the UK. So not that difficult to fill a residential property. I appreciate there's nuance around the country, but in general terms, it's easy to rent those out. That's not the truth with commercial. There's a reason we see the high street boarded up and not many. What's the demand for that particular property? Just because you've got a tenant in there, if they decide to leave How quickly can we replace that? Do you have the cash means to cover any void periods? Because you're going to be paying the business rates on this and another expense that's associated with that as well. So whilst it is attractive and appealing, and as you say, a bit sexier than your standard residential stuff, it's not without its risk. So understanding market cycle, is the planning use class you've got suitable for the location that you're in? I take, for example, it's a bit of an extreme one, but let's say C2 planning, which is nursing homes, which is commercial. You could argue that's mixed use because it has a commercial use, but it's ultimately a house. It's got a different planning category on there. Is, if that goes, who are you going to fill that back with? You can only fill it with a certain type of business, and is there demand, and so on. So there's a lot to consider around that on there as well. And the other thing I just touch upon real quick is a lot of people will come to us and with this great idea, and it is a good idea, is that I'm going to split the titles, I'm going to take the commercial, it's going to go into my pension, I'm going to do all this wonderful stuff, and I'm going to do this, that, and the other, and it makes sense. And we can do an episode on that separate. One health warning is the ground floor of a shop and upper usually isn't worth that much, 50 to 100k on a standalone basis, vacant possession. Trying to get a mortgage on that is exceptionally difficult because of its value. So it does allow you to do a few more bits, but again, it comes back to what's the objective? Are we trying to be clever for clever's sake? Or are we actually playing the game at the right level to make sure that the outcome is the outcome you desire?
Yeah, absolutely. So a great point, because we were just going to kind of run into some of the pros of investing in semi-commercial property. And one of the things on that list is the ability to use your pension potentially to fund the commercial element under a title split, because you can't hold any residential in your pension, but there is the ability to split the title. And I think you're spot on. The majority of those investments that we see from an investor perspective that are high yielding are in lower value parts of the country. And so your point's very valid. In other parts of the country, yes, the commercial element may be a lot more expensive, but those are less in demand from an investment stock perspective. So, having the ability to use SIP or SAS is obviously very good. We've already covered off the stronger net yields based on compared to buy-to-let, obviously, and in comparison with your HMOs or your multi-unit blocks. The one thing for me, which I love around commercial property, is there's two things around the commercial element, which is tenants usually have longer lease terms. So they can be 15, 20 years, but the majority of what we see is somewhere between 3 and 5. Anything up to 7 years doesn't need to be registered at land registry. Anything over 7 years or above needs to be registered at land registry, and that comes with a different challenge then, and it comes with different rights. So that's something to bear in mind if you're not aware. But so the tenant fine fees and things like that, once you put a tenant in, you haven't got to worry about it. It's not an annual renewing tenancy. It's a one-off, as in you'll obviously write the lease up to suit you both. You can agree on the terms. Is there upward rent reviews and things like that? Are there any rent reviews? Are there any break clauses? But once that's agreed, it's pretty much done and dusted. And the second part of that is an FRI lease, a fully repairing and insuring lease. So a tenant on a commercial property will cover their share of the insurance, and they'll also fully repair the property. So it's their responsibility to maintain the property. I've got a few semi-commercial properties which I own, and this was an example the other day. I was having a coffee the other morning, and one of my tenants said to me, as it happened, the plumber walked in, and she was saying, do you know where this is, or do you know where that is? And I said, I have no idea. I haven't been there for 5 years, so I'm not sure where any of those things. And she just started laughing. She said, "You're not interested in you?" I said, "No." And so, the reality is, it's, if you want to do something, you crack on. It's within your lease that you can do that. There's certain things that you need to seek permission from the landlord to do. But overall, it's internally, if you want to do work, you can do that, but it's at your expense. And then if anything goes wrong within the property, that it's up to you to fix it as well. So there's a lot less maintenance costs from a landlord's perspective on the commercial element. and maintenance and repairs are all sorted. So it's a lot more hands-off and a lot more passive than residential property. So that's two of the real positives of commercial. We mentioned earlier the lower stamp duty potentially, depending on where you are and what the value of the property is. Some pros and cons. There's obviously yesterday's announcement with a budget, and we don't know what this is going to look like yet, but there may be lower value commercial properties may become more attractive now. It looks like the government seems to have helped that a little bit, because they mentioned that any properties worth 500,000 or less will see their business rates go down. But some properties worth of 500,000 or more, business rates will go up. So again, it depends on the value of the property. Will depend on whether that's a pro or a con. And yeah, I guess there's probably there's probably a little bit less competition for semi-commercial properties, than there is for residential. You see a lot of the homes under the hammers and a lot of the property education and things like that they're teaching, and people who are dipping their toe in the market will inevitably go in at the lower end. So the 60, 70, 80, 90,000 pound houses, there's a lot of competition for those. So when they come on the lower end of the market, there's usually a flood of viewings of people trying to buy. Whereas when semi-commercial properties come onto the market at the lower end, there's probably nowhere near as much interest. So you're competing with less people, in which case there's a chance to do better deals.
Yeah. And there were two bits there to add to that. Is I'll go back to the break clauses just real quick on that front. So a break clause is a clause in the lease whereby the occupier can, with written notice or whatever the terms are of that break clause, they've done nothing wrong, everything's all fine, but they can give notice and they can leave within a particular window. So very often you hear the phrase 2-year breaks or 3-year breaks, whatever. So that's what that happens. Now, you may have a 20-year lease in your hand that's dated from today for the next 20 years. If you've got a 2-year break clause or a 3-year break clause, you've actually got a 2-year lease, not a 20-year lease. So you'll go through the rigmarole of registering it with the land registry and everything that comes with that and the expense of doing it. But in reality, you've got a 2-year lease. That's how the lenders will treat it as well. So, and I've seen that happen where people have negotiated really hard in their lease conditions. And gone, yeah, look, I've got this 10-year lease and they guarantee that income. And I'm like, what's your break clause? Or 2 years? Well, they can leave in 2 years. Now, don't get me wrong, outside of that 2 years, it becomes an 8-year lease for the remaining term, or a 7-year lease, depending on how it's worded. So that's a trap I see people fall into. And then the other point really was around the other conversation we have on the mixed use side is people looking to buy a mixed use property. So it's usually shop with uppers is the most common one. They buy it, but the intention is to convert the ground floor back into residential. Now, I don't know if there's any stats or anything like that, but the desire for local councils to give up that retail space to go back into residential is limited at best. So I would suggest that unless you've done your homework and you know that is definitely something you can do, because the words PD get bandied about, and I'm just going to it's still a planning application. It's got to go through, albeit a light to touch one. They can still decline it. And as such, I've seen people sort of run into that space thinking they're just going to do this. So they've got a tenant with 12 years left on their lease. I'm going to chuck them out, convert it into residential. I'll have a block of 3 flats, for example. It's just not that simple, is the short version.
Yeah, ultimately, we've seen a couple of these that we've looked at. Is a prominent corner building on a high street, ground floor retail or commercial is very unlikely to get changed into residential. Whereas if you've got a semi-commercial block where somebody's maybe changed the living room into a commercial space, or the downstairs, into a commercial space, it might have been a dentist or something like that, and it's in a row of residential houses, that's probably far easier to get that through planning. Whereas somewhere on a high street is going to be far more difficult to convert the ground floor, because whilst the retail space is, the high street is struggling, councils and the government don't want to see the high street disappear either. And so, yeah, that's all definitely something to keep an eye out on.
Yeah.
Did you say you had another point as well?
No, I think the other one that you also mentioned as well was rent reviews upwards. I know the government have got that under review currently, but as it stands right now, from you as you as the landlord with your rent review upwards on an annual basis, and you've already set what that's following, whether that be RPI or CPI. So these are the inflation indexes, consumer price index or the retail price index. So it's very much prescribed. So you just send them a letter with a new rent for the new year. There's no negotiation. It just is what it is. It's written in the lease. Whereas if that's an AST or an occupational contract, you need to be engaging with a tenant. Theoretically, you want to be redoing your affordability and resetting that. No, commercial. Here's your letter. Here's your new rent for the next 12 months. Thank you very much. I'll expect to see that in my bank account next month. Thank you.
Yeah, absolutely. Okay, so let's cover off some of the negatives then, or the risks around semi-commercial as opposed to other forms. One of them we've already pretty much touched on is more complex finance. There's a lot less lenders in the market than there is for just standard buy-to-let, etc. And it tends to be a bit more of a manual underwriting process, and therefore a slower process. What's your experience with that? Is that correct? Does semi-commercial, commercial mortgages, do they take longer than usual, than other forms, rather?
Yeah, I mean, the question I'd have is, are the other forms that quick? Probably not. So, look, it's nuanced, isn't it? If it's a very straightforward building and you've got a corner shop on the ground floor, 2 flats, shops occupied, leases easy to see, and all that sort of stuff, then that should be fine. I think you need to remember that ASTs are templates, so they follow a set form. Same with occupational contracts. Commercial leases can look however you want them to look in many respects. You're going to have to pay your solicitor to put together a proper commercial lease. Downloading one off the internet and filling in the blanks probably isn't going to cut it. Not if you want it to mean anything, because the lender will want to have a look at it. So you will have bits like that. So if the lease isn't right between you, let's say you're buying and it's already occupied, if that lease isn't up to scratch, it could be delayed because you now have to go back to the current tenant, renegotiate the terms of the lease to make sure it matches or fits in with the lender's criteria. So it can be a bit more protracted, yeah.
Yeah, absolutely. One of the other ones that I've probably experienced is historically is lower loan to values. So whilst you can get 75% lending in the semi-commercial space, whilst we've got a smaller pool of lenders to choose from to start with, there aren't a huge amount of lenders that will lend 75%. And there's a lot more options in the 70% and 65% space, isn't there? So yes, you can get mortgages at 75%, but there is a far larger pool out of the smaller pool that play in that 65 to 70% space, isn't it?
Yeah, 100%. Well, no, they don't do 100% mortgage. I 100% agree with you. So, if you're serious at semi-commercial, I would be budgeting 70%. Yes, you can get 75, but then they may look at the vacant possession value rather than if you want the investment value. So again, what are we valuing is the question.
Yeah, absolutely. One of the other risks then is longer void periods potentially on the commercial element. We've talked about, everybody knows the shortage in housing, for instance, on the residential side. So if you've got a couple of flats in the uppers, 1 beds, 2 beds, big demand for those. So if one tenant gives you notice, the chances are before the month is up and you'll have a new tenant in there. Whereas on a commercial element, if that commercial property becomes void, the chances that there's not exactly people queuing up to take them. It depends, obviously, area, location, its cost, etc. But so you could face longer void periods, which is again why we talked about the need for experienced landlords and also maybe the ability to cover void periods. So through income and other assets, which is why they generally want experienced landlords. And also what we just touched upon again is what people aren't always aware of is business rates. So if the property is empty, then the landlord pays the business rates on that property. There's one example which I talk to people about quite a bit in our local area. The council closed they built a new swimming baths and leisure centre, and when they had leased it out to a charity, a charitable part of the council, and so there was no business rates. But when they took over the new swimming baths, the property ended up back in the council's hands, and the business rates was about £1 million a year. So rather than paying the rates to themselves, they just knocked the thing down. And so there's no idea what they're going to do there, but it was cheaper for them to knock it down before they decided what to do with it. So that just highlights the need that people aren't always aware of, that they are due to pay the business rates should the property be empty. And if it is a longer void period, then that is something that you have to factor in then.
Absolutely.
And then that goes with saying around demand, which we've already talked about. We've talked about potential planning issues if you wanted to commercial, if you want to change it from commercial to resi. There's probably a few more fees involved. That's probably one of the negatives. If you're talking about, we've already talked about the need for fire risk assessments, asbestos reports. There's also generally valuations are more expensive because they're a bit more complex in nature. Legal fees will be more expensive, again, because you're asking a solicitor to look at the commercial element and the residential element, and commercial lenders tend to make you pay for their solicitors as well. So, and then you might want to be getting tax advice as well. So there's quite a few additional fees that you probably need to pay.
Yeah.
And it's just generally a little bit of a slower market in terms of, we talked about the demand of people queuing up. So if you want to exit, if you need to sell that property for any reason, you probably are playing in a smaller pool of investors, generally investors looking to take that property on. So liquidity is a little bit slower probably.
Yeah, I'd agree. I mean, one of the things that we didn't necessarily talk about in so much as a pro is, which would help mitigate some of that, is you have the ability to sweat the asset a bit further. So whilst you won't have 100% of the benefit of this because it's mixed use, in commercial, the value of the commercial unit is very much underpinned by its covenant, its lease and the lease quality. So one of the ways you can influence the value of your investment is by putting a better tenant in there on better terms. By doing that, you package that up, makes it all more attractive. So, that can mitigate the liquidity issue, because if it's a already packaged up investment and you want to exit out of it, you probably will have a queue of sensible buyers waiting for you. But equally, the asset value is greater, and you can do that. So, yeah, that was one I wrote down that we missed out.
Yeah, that's what we call in investment terms, that's what we call asset management, isn't it? Mm-hmm. Where you basically buy a property, renegotiate a lot of the terms on the existing contracts, put in longer lease terms, take away break clauses, increase the rents and make it more favourable from a landlord's perspective, and you can almost double the value of a property just by some paper exercises. So absolute great example of a positive towards semi-commercial investing. Yeah. So anything, I think we've covered pretty much quite a lot there. Is there anything that you think that we missed out or that we need to cover off?
No, I just think with regards to the borrowing, just be prepared to answer the questions. If it is empty, then, it's a classic really, is this is a great opportunity. The shop's empty, you've got the flats above. I'm going to do this, this and this to the ground floor, and it's going to be occupied. And it's been empty for 10 years. What makes you think that you're going to do anything different and so on? So I get it. I understand it. There is an optimism when you're looking to buy something and you can see the potential in it, but then also you've got to be realistic about the risk. So just be prepared to answer the questions to the lender. And work with the lender. They aren't doing it to be awkward and difficult. They have to justify why they're lending this money and make sure it's a sound investment. So whilst you might feel like it's a bit, death by a thousand cuts sometimes, and it can feel like that sometimes, there is a rationale for it. And also it's a protection mechanism for you as the buyer. If you can't satisfy the lender that it's the right thing to do, then you've got to be asking yourself the question, is it actually the right thing to be doing? So just bear that in mind, that's all.
Yeah, absolutely. So, I think we've covered most of it off. And ultimately, if you're thinking about buying a semi-commercial property, then, obviously we urge you to speak to a good broker. Obviously, that could be us, hopefully. But if not, then speak to another. There's plenty of good brokers out there who will hold your hand. They'll understand which lenders are available to you in this market, which ones to avoid based on the deal and based on your analysis. Because ultimately, the finance part of it can make or break the deal. And getting that right advice up front can save you thousands in fees. So I highly recommend that you speak to someone, and the more eyes you can get on your deal before you go ahead and pull the trigger is going to be better for you from an investing perspective, so that you don't throw money away. So yeah, thank you for your time. And like I said, if there's anything that's been of interest in this episode, then just reach out to us, drop us a message, give us a call, and we're more than happy to run through something. If you've got a deal that you want to look at, more than happy to sit down and go through that with you and review your options. So other than that, thank you very much. Thanks, Mark, and we shall see you on the next episode. Thanks so much for listening. Really appreciate it. And, hopefully you had some value from that. As always, we really appreciate you listening and value your feedback. If you've got any questions, we urge you to ping us a message with those, or if there's a topic you'd like us to go into a little bit further. And also, we do really appreciate you liking, sharing, and subscribing to the podcast. And thanks very much. And we shall speak to you soon and see you on the next episode. Have a good week. Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested. And of course, subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.